Screen. Okay, so I'm just working through some things that I'm studying for the CMA. So I figured I'd make a little video to help me play back these things. Okay, my computer's laggy apparently. Hmm, oh, I'm stupid. Okay. All right, so I'm just working through some things for the CMA, and I figured I'd make a little video talking through everything. This is probably only really helpful for me, but could be helpful for someone else, so I guess I'll post this publicly. So, regarding profitability, some of the factors that impact how profitability is measured, one of those is revenue recognition. Just a reminder that revenue is recognized when realized or realizable and earned. Um, so for example, to recognize revenue, if you have a contract with a customer, which is basically like anytime you sell anything or do a service, like you have a mini contract basically when you sell something at a store, as in like I you picked out this item, you're buying it right now, and you have a limited time to return it. And then like a service, you have an actual written out contract because that's more specific. So steps for revenue recognition when there's a contract with a customer, first you need to identify what the contract is. Find it, note what the contract number is, definitely read it over. Step two is you identify the performance obligations with the in the contract to the customer. So if you're doing a service, and the performance obligations are building 5 different buildings, then you have 5 performance obligations. Step three, determine the transaction price for the contract in total. So let's say it's $1 million to build these 5 buildings. So then step four, you need to allocate that total transaction price to each of the performance obligations in the contract. So if the total contract's $1 million and there's 5 buildings, maybe you just do it straight up and yeah, you probably will do it straight up and just say each building is $200,000 for the performance obligation. And then step five, you recognize revenue when a performance obligation is satisfied because for the example we're doing, you're not gonna finish all 5 of the buildings at the exact same time. You're gonna build one building at a time, probably, or a couple at a time. So as each one is finished, you can recognize $200,000 of that revenue instead of having to wait until all 5 are finished. But on the other side, factors that impact profitability are costs. And specifically, I wanted to talk about cost of goods sold, COGS. It's actually generally the largest cost for merchandising manufacturing companies. And it includes product costs, which are expensed when the product is sold, and until then, the costs are being accumulated in the inventory accounts. COGS has 3 inventory accounts to account for these product costs. There's raw materials, work in progress, and finished goods. Profitability on the income statement. Net sales for these ratios, net sales is always the denominator, and each ratio is expressed then as a percentage of net sales. So if we're looking at the gross profit margin ratio, we're trying to figure out what percentage of gross revenues remains in the firm after paying for the inventory, the merchandise. And it measures if firms are keeping up with the increase or decrease in sales. And this ratio is calculated by dividing gross profit, the dollar amount, by the dollar amount of net sales. And it gives you the percentage of gross sales that a firm keeps after paying for merch. So, to kind of put the nail in the head here, I've got the financial statements for Mercado Libre opened up. And so we have um, total revenue, which is 20,777,000, and cost of revenue 11,200,000. That gives you gross profit. So then you would divide the gross profit of 9,577,000 by the total revenue of 20 million in order to get your gross profit margin. And then next is the operating profit margin, kind of similar, but it's the next step down. It's what percentage of sales remains after selling and general and administrative expenses have been paid. And that's operating income divided by still net sales, as I said before. So we've got operating income, which is 2,600,000 something thousand, which comes from gross profit and subtracting out selling, general admin, R&D, doubtful accounts. So you take that 2.6 million divided by your total sales of 20.7 million, and you get your operating profit margin. And so here's a question. If we increase the selling price of Mercado Libre's, uh, what they do, by $10 per unit, and with no effect on the volume of sales, so demand isn't affected, what does that do to the operating profit margin? Think about it. Operating profit margin, that's operating profit divided by net sales. That's actually going to increase operating profit margin. So yeah, total revenue will increase as well, but the selling price is increasing and cost is not changing at all. So actually operating income is going to increase as well, and probably by a bigger margin than revenue is. So that's why it increases that. Finally, net profit margin. That's what percentage of revenue remains after interest expense and taxes are paid. And that is net income divided by net sales. So we've got net income. I lost where it was before. Okay. Yeah, so we've got net income 1.9 million, and we divide that by 20.7 million, and we get our net profit margin. Some uh, profitability examples from the balance sheet. We have return ratios. There's two types. They're return on assets and return on equity. Blup, blup, blup. Oh, I guess I meant to pause. So the first one, return on assets, that is net income divided by average total assets. And average total assets is the previous year assets plus the current year assets divided by 2. So our numerator is still, if we go back to the income statement, that for that 20.7 million, and we divide that by 17.6 million plus 13.7 million divided, oh, sorry, those are the wrong years. 25.1 1 million added to 17.6 million and divide that by 2. And so if we want to use the DuPont model to break this down, remembering that the DuPont model splits a formula into 2 or more components and allows us to understand more about the factors that contribute to the ratio, we'll demonstrate exactly how that helps us understand this return on assets. So we start out with the original formula of net income divided by average total assets, and we break that down into net income divided by net sales times net sales divided by average total assets. So we see that increases in sales decrease our net profit margin, um, which, and that can kind of be explained if we go back to the start, because like the net sales will cancel out. Uh, I That's what the book said. I wish I could do the math on it right now. I'll probably do that maybe in a different video when I review later. So anyway, we have net income divided by net sales times net sales divided by average total assets. We could break that down further into just the net profit margin times total asset turnover. So shareholder return can be explained in terms of both net profit margin and the efficiency of asset management. So net profit margin for every dollar of sales, how much does the firm earn in a return in the form of net income? And total asset turnover tells us how it measures the level of capital investment relative to sales volume. So if net sales increases, shoot, I lost my place. So if net sales increases, asset turnover ratio improves. Oh, okay, so that explains before. So net income divided by net sales times net sales divided by average total assets increases in sales, decreases our net profit margin. So when we look at the efficiency use of assets, such as how frequently, the total asset turnover looks at the efficiency and use of assets, such as how frequently you can turn an asset into sales. Similarly, another way we can look at profitability on the balance sheet is return on equity. And that measures return on owner dollars invested. I meant to say return here. And that's divided by net income by, that's, oh, excuse me, that is net income divided by average total equity. So you take the net income, 1.9 million, and you divide it by the equity. We can use this. 4.35 million plus 3.071 million divided by 2. We can use the DuPont model to break this down further. So we have the original formula, net income divided by average total equity. And that it can be written out as net income divided by net sales times net sales divided by average total assets times average total assets divided by average total equity. And that is, I don't know how that got messed up there, but the net profit margin times asset turnover times the equity multiplier, which then we can break down into return on assets times the equity multiplier. Return on assets is net profit margin times asset turnover, which we got from before. So return on equity is kind of really divided into three different efficiency components, right? It's like return on assets times the equity multiplier. And return on assets was net profit margin times asset turnover. And just to get deeper into that, equity multiplier measures a firm's financial leverage. So if the equity multiplier is high, there's more debt reliance, which increases return on equity but decreases solvency. And a low equity multiplier means more equity reliance. So how does the use of leverage affect the financial risk of a firm? The higher the level of financial leverage, the higher the financial risk to equity holders. It may be appropriate for firms, for example, mature industries with little variance from period to period income, to employ higher levels of financial leverage, and which is more appropriate for high growth firms. And it would be more risky for firms that have extreme variance in income to employ leverage, as the probability that income may be insufficient to service the debt, meaning pay the interest, becomes greater. Factors that impact return on equity are financial leverage, net profit margin, and asset turnover ratios, as we just talked about. Two limitations of financial ratio analysis: different firms may use different accounting methods acceptable under GAAP, like Mercado Libre could use LIFO and Google could use FIFO. Or Mercado Libre could use straight line depreciation, and Google could use accelerated depreciation. Or another limitation is differences in currencies, business environments, or industries. Google is an American-owned company. Mercado Libre is not. So these dollar amount dollar amounts are converted from somewhere. Accounting changes. There are three types. The first one is change in accounting principles, and these occur when an entity either adopts a generally accepted principle different from the one previously used, like from going LIFO to FIFO, or when they change the method of applying a generally accepted principle, or when they change to a generally accepted principle after the principle previously used is no longer generally accepted. So when a change in accounting principle occurs, a firm has to apply this in their financial statements retrospectively. So that means the carrying amounts of assets, liabilities, and retained earnings at the beginning of the first period reported will be adjusted for the cumulative effect of the new principle on all periods not reported. So all periods reported must be individually adjusted for the period-specific effects of applying the new principle. The next type of accounting change is change in accounting estimate. And this occurs when new information reassessment of when new information causes the reassessment of future benefits and obligations. An example of this is the change in estimated useful life of a depreciable asset. So for example, if if the term, for example, the terms changed on the this non-current note receivable from maybe it's 20 years, and then the terms changed to make it 10 years. That's going to change how much they depreciate this asset. And they apply this change prospectively. So that means that only affects the period of the change and any future periods. So meaning it affects the present and the future. So you have to reassess and change what we record in the current period and for the rest of the useful life of the, for example, non-current note receivable. The third type of accounting change is change in reporting entity application, and that requires a retrospective application to interim and annual statements. So if we come back here, retrospective application, we change the carrying amounts of assets, liabilities, and retained earnings at the beginning of the first period reported and at interim and at year end for everything. Now let's talk about earnings per share, aka EPS. It's commonly thought of as the most relied upon performance measure used by investors, and it's the amount of current period earnings that can be associated with a single share of a corporation's outstanding common stock. And it only uses common stock here because common shareholders are the residual shareholders of the corporation because preferred shareholders have a superior claim to the firm's earnings. All firms have to at least report basic earnings per share, which we'll cover in a second. So a firm with a simple capital structure only has to report basic earnings per share. So if we take a look at Mercado Libre, if we go to the summary page, they should have earnings per share. They have it as 40.98. So that's earnings of about $41 per each share of common stock. So now let's get into how that's calculated. Basic earnings per share formula. Net income available to common shareholders divided by the weighted average of common shares outstanding. So, and Mercado Libre already conveniently had net income available to common shareholders calculated for us, which was as of 2024, the 1.9 million that we used before. But if we didn't already conveniently have that, that would be calculated by net income minus preferred stock dividends. Preferred stock dividends. They might not, yeah, they might not have any. Let me check the balance sheet just to confirm. So they have common stock, but they don't have preferred stock. So that explains why this net income to common shareholders is the same as regular net income. So anyway, we have net income available to common shareholders divided by the weighted average of common shares outstanding. We already covered the numerator. So for the denominator, you have the weighted average of common shares outstanding. And this is a more complicated calculation than you would think because it's weighted average, not just average, right? Average, like we did before, we had for return on assets, we had the average of the assets. So we had 25.1 plus 17.6 divided by 2. But weighted average, we're also now multiplying by the time that it was around divided by the total amount of time we're measuring, which is a year, right? So we start with the beginning balance of common stock, which was 3.07 million. And forever, how long that balance was unchanged, you multiply it by those months. So maybe let's say they didn't do anything for 6 months. So that would be 3.07 million times 6 divided by 12. Then, if there's any stock dividends or splits, well, sorry. If there's any stock dividends or splits, that changes this beginning balance that you use for your calculation then, since those are deemed to have occurred at the beginning of the period. However, if shares of common stock are issued, so let's say they increase this by 1.5 million, right? So we're beyond this number right now, but that's okay. They increase it by 1.5 million, so you do the total number of shares times the months until the next transaction divided by 12 months. So maybe they leave it like that for, oh, these are in dollar values, but um, I don't, let's just say this is just the number of shares for simplicity. So we now have 4.5 some million shares, and they're going to have that for so times 3 months divided by 12. So then in the last 3 months of the year, they repurchase 200,000 of those to get back to this 4.351 million number. So then you multiply this times 3 months divided by 12, and I hopefully you kept track of all of these other numbers because now you get to add them together, and that's the denominator. So another type of earnings per share, this is diluted earnings per share. It's a category a firm must report of earnings per share if they have preferred stock or dilutive potential common stock on top of reporting that basic earnings per share that we just covered. And since we saw that they don't have preferred stock, and I saw over here on the income statement, diluted net income available to common stockholders is the same as net income. Basic EPS is the same as diluted EPS and diluted average shares. That means that they also don't really have that going on, but we're still going to cover this. So the formula for this is net income available to common shareholders with kind of a bit of a caveat. Or let me say it again. The formula for diluted earnings per share is net income available to common shareholders divided by weighted average common shareholders outstanding, which sounds exactly like the basic earnings per share formula, but there's caveats to both the numerator and the denominator. So the numerator, for example, you increase the numerator by amounts that would not have to be paid if dilutive potential common stock had been converted. Namely, dividends on you increase the numerator by dividends on convertible preferred stock, and you increase the numerator by after-tax interest on convertible debt. And so to calculate the numerator, you start with net income available to common shareholders, which is that net income minus preferred stock dividends. But note that at the end, we add back declared preferred stock dividends. And so we can just start with net income and ignore that, actually. But since diluted net income available to common shareholders is the same as net income to common shareholders, like, yeah, again, we can start there. So we add back the after-tax amount of the interest expense of the convertible bonds from the current period. So let's say the bonds have a $100,000 face value and a 10% conversion rate, and the tax rate for Mercado Libre, I mean, they're pretty big, so let's say 40%. So that's $100,000 times 10% times 1 minus 40%, 60%. So, and then after that, you add back cumulative preferred stock dividends, which occurs when you hear them say no dividends were declared this year. That means dividends were accumulated. And these cumulative preferred stock dividends are calculated by the number of preferred shares times the par value per share, per preferred share, times the percent dividend. So there were no preferred shares from Mercado Libre, but let's say that that was 10,000 and the par value per share is 2 and the percent dividend is also 40%. So that's 10,000 times 2 times 40%. That's the numerator. The denominator is increased by the weighted average of shares that would have been outstanding if dilutive potential common stock had been converted. So steps for the denominator, you start with the weighted average of outstanding common shares, and you add back the information for bonds. So, like we had, let's see, one had one $100,000. No. The number of bonds. Sorry. Let's say, going back to the bonds, there's 10,000 bonds. And the number of shares a bond converts to it. Okay, yeah. The number of shares a bond converts to is, what the heck? I don't think I wrote that very well, but I'll just move on. And then you also add back the additional preferred stock shares that would have been outstanding. So you have the number of preferred stock shares divided by the number divided by this next fraction, number of preferred shares it takes to convert over number of common shares the preferred shares convert to. So to that second fraction, that's like saying if you get if you give me 5 preferred shares, I'll give you 2 common shares. Okay? So instead of having number of preferred stock shares over a fraction, you can just go ahead and multiply and flip it and say the number of preferred shares times the number of common shares the preferred shares convert to, divided by a number of preferred shares you trade in to convert. So that would be the number of preferred shares times 2 divided by 5, for example. The next type of earnings per share is the book value per share, and that measures the amount of net assets available to common shareholders as a per share value. Limitation of that is that it's based solely on the amounts recorded in the books. The book value does not equal the market value. And this is calculated by total stockholders equity minus preferred equity over the number of common shares outstanding. Or you could say it's common equity over common shares outstanding. So, We have total, going to the balance sheet, total stockholders' equity. Mhm. So that would be in 2024, these 50,000s and the 225 minus preferred equity, which is zero, but if there was, that would be here as well. And you divide it by the number of common shares outstanding, which you would probably have to get to by dividing, like if they had said the par value here, which was $4, you would divide 50,697 divided by $4 to get the number of shares. And the numerator for that, so there's two ways to find, again, coming back to it, total stockholders' equity minus preferred equity. There's a couple different ways to. Okay, wait. Let me rephrase this. The numerator, which has the second way you can find what we're looking for, can be written in two different ways. So, what we're looking for is net assets attributable to just common shares. The way that we saw in the formula is total stockholders' equity minus preferred stock equity. But a different way you could find it is the par value of common stock plus additional paid in capital of common stock plus retained earnings. And for the denominator, that's just the, like I said before, the dollar value of the common stock on the balance sheet divided by the dollar par value of the stock on the balance sheet. Price earnings ratio, aka the PE ratio. It's a market-based valuation tool, and it's market-based because the numerator is the market price. So the formula is the dollar market price per share times the dollar earnings per share, which gives you a number that you say is like X times. So let's go back to our summary here. So the dollar market price per share right now of Mercado Libre Meli is, I think that's, yeah, that's the aftermarket price. So we'll use the closing price, $2,057.72. Okay. And earnings per share is 40.98. So you would divide 2057.72 by 40.98, and you're going to get a fairly big number. So you're going to say that the PE is X times. So growth companies like to have a high PE ratio because it reflects the stock market's positive assessment of the firm's earning quality and prospects. So, like we were saying before, it's the market price per share divided by earnings per share, which is 41, and we got 50, which is kind of big. So, Mercado Libre thus is a, we can think of it as a growth company, and they are, which is accurate, they are quite big because their market cap, if I can find it, is over 104 billion. So that thought process tracks. Earnings yield. It's the rate of return on the purchase price of a share of common stock. So the amount of earnings an investor expects to receive per $1 invested. And it can be compared by investors to other types of investments to determine whether a given stock is comparable to other stocks or to alternative uses of the investment money. And so the formula for the earnings yield is the dollar earnings per share divided by the dollar market price. So it would be the 40.98 divided by 2057.72. But wait, doesn't that sound familiar? That's because the earnings yield formula is the reciprocal of the price earnings ratio. And reciprocal means it's just flipped over the fraction bar. So that's easy to remember. If they give you the earnings yield, then you can get the or oh my gosh, the PE ratio. And a couple types of dividend ratios. We have the dividend payout ratio and the dividend yield. First, the dividend payout ratio measures portion of accrual basis earnings that was actually paid out to common shareholders in the form of dividends. Um, so let's see. So let's see the formula for the dividend payout ratio. It's dividends to common shareholders divided by income available to common shareholders, and you're going to get a percentage at the end. So the numerator, you find this by dividends per share times number of outstanding common shares. So dividends, let's go to our financials again. Would be there. Okay, well, there were dividends, but I don't have access to that because I don't pay for Yahoo. Um, but let's just say, let's come back to our balance sheet. Let's just say they issue 10 cents of a dividend per share. Okay. So there were 50,697 shares in 2024. And so each share gets 10 cents. That's the dividend to common shareholder. And if you want to determine the outstanding common share number, if they didn't give us the number, um, like if they said uh, whatever the price is for it times four, let's say they said $200,000 ordinary shares, and we need to figure out the number of shares, you would divide that total number by the par value, that's that dollar amount, and you would get the common shares. And so the denominator is net income minus preferred stock dividends. Okay, so let's come back here. Dividends to common shareholders, so that's the 10 cents times 50,697 divided by income to available to common shareholders, which is net income minus preferred stock dividends, which Mercado Libre has as of 2024 is 1.9 million. So you're going to get, at least in this example, a small percentage because I used a 10-cent dividend. Uh, Another example of a dividend ratio is the dividend yield. And you could want it to be high or low. It depends on what type of investor you are and what you're looking for. So, for example, are you an investor that wants dividends? If so, you want a high dividend yield, and you'll see why in a moment. But if you're an investor that wants the earnings of the business to be reinvested into the business to grow the business, then you're going to want the dividend yield to be low. So the formula for the dividend yield is dividend per share divided by market price per share. So in the in the example I gave, wow, um, you would let's say you had that 10-cent dividend per share, you would divide 10 cents by $2,057 per share, which is going to give you a really small percentage. So hopefully, whatever dividend Mercado Libre does, if you want dividends, hopefully it's a better dividend than 10 cents. And that's all I had for now. Thank you.